Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've seen the latest retail trade figures for the second quarter of the year, a touch more upbeat than we might have first expected. Overall, spending up 0.5% quarter on quarter on a seasonally adjusted basis. Looking through the numbers, feels like there's maybe a little bit more under the surface when it's come from spending from households and otherwise than we might have first expected, at least considering that all of the other economic indicators for the second quarter did feel like they were a lot weaker than we might have hoped, certainly not as strong as the first couple of months of 2025.
Yeah, that's right. I mean, it was a surprisingly positive result, not massively positive, but certainly, like you say, maybe a little bit better than had been anticipated given some of those other indicators coming through. I mean, you look through the numbers, households are not rushing out to the shops and spending all they can, but there are signs, across the board when you look through most of the sort of spending categories that there is a bit more activity happening through there. I mean, there are some clear exceptions. You look at, for example, the sort of hardware and homeware areas where the housing market is weak, construction activity is weak, and that is still pretty heavily reflected in those numbers. But across quite a lot of other store types, there was a bit more positive growth coming through. Now, as I say, it's a little bit patchy. There's still a bit of reluctance around some areas of durable spending, although even in there, when you look at sort of electronics spending, that was a relatively positive result. But sort of other indicators that we're getting through around that suggest that if anything, the spending growth is coming through a bit more in some of those sort of consumable areas, and maybe that reflects a little bit of price inflation in some respects, and also stuff that people kind of can't avoid having to buy. It is those necessary items, whereas some of the more discretionary areas are still a little bit of weakness, but not all of them as well. I mean, spending around sort of hospitality, again, showing through in terms of a bit more activity coming through there as well. So it may be that people are just starting to loosen those purse strings a little bit more. We know that in terms of the headlines over the last year, that hospitality industry has been coming under a lot of pressure, and there's a lot of businesses that have been particularly hurting there. But it may well be, just as those interest rates are coming down, people are finding a little bit more money to go out and spend in some of those areas. But it is still a fairly early stages of the recovery that we're seeing at this stage.
And I think interesting as well that the spending trends that came through in the retail trade survey really did map quite well to what we're seeing in our latest quarterly economic monitor in terms of the sort of regional distribution across the country. South Island spending growing at a much faster, much more sort of sustained clip than what we saw in the North Island. Particularly driven by the likes of Otago, again, tourism, but also with one of the lowest unemployment rates in the country, with more jobs growth, or at least not jobs decline, all of that sort of adding through. And again, a little bit of that sort of provincial rural versus urban shift, where you're just not seeing quite as much activity happening in some of the bigger centres. Not quite as many jobs, particularly because of a downturn in construction in those areas, sapping a bit of strength. On the other side, of course, better primary sector activity, not immediately bolstering spending quite a lot, but enough to just sort of show a little bit more below the surface. I've also been interested in looking at some of the data recently, and this sort of, I think, goes to your point around that sort of early stage of the recovery. The latest One News Varian poll showed that around 43% of households thought that the economic outlook for 12 months' time would show basically the same as what we're getting here today. So even with those lower and lower interest rates, people are seeing some of those higher costs, like food price inflation, now back at 5%, and going, well, it makes me uncomfortable. I don't feel like the recovery is coming through quite as strongly. And that's actually the highest reading that we've seen of people saying they think the same economic conditions will be there in a year's time, rather than actually making a view that things will be worse or better. Highest reading on that measure for a decade, back to 2015. But you have to go back to like the 1980s or so before you start to get into a couple of months where people are just so sort of unsure and uneasy about their economic outlook. Yes, some better spending trends for now, but some concerns still about how quickly things will warm up. What's your expectation for sort of the next couple of months as we head through to the end of this year? Are households going to spend, or are they going to sit on their hands?
Well, I think one of the other key numbers coming out of some of the consumer confidence surveys, ANZ one in particular, showing that people, when you ask them about their current financial situation, they are still quite downbeat about that. We've seen a gradual improvement in some of the other numbers that feed into overall consumer confidence measures, but that one stands out to me as still being on the weak side, and it does reflect, I think, the fact that the labour market is still yet to turn and yet show any signs of really turning. And people are looking at that and going, okay, I've still got a job, but do I still have a job tomorrow? And if I don't, there's potential issues there in terms of actually trying to find employment because there are not a lot of opportunities out there. So I think there is still caution from people in terms of their approach to spending, given how the labour market is, and indeed given just how stretched they will have been over the last couple of years with higher mortgage rates. People are going, well, you know what? I'd actually rather just continue to sort of feed more money into the mortgage in the near term to make sure that I'm kind of ahead of the game around there. You couple that with some of those necessary items which are going up in price still quite substantially. You mentioned food prices, local government rates, insurance, electricity, all those things feeding through and just weighing on people's sort of perceptions of how their sort of spending ability is going relative to what incomes are doing. And so all of that for me suggests that probably through the second half of this year, you don't want to get too excited about how that retail sector is going to go. Not saying it's going to be contracting, but sort of growth, even with the better export prices and incomes flowing through into provincial areas, even with the labour market maybe just starting to turn. I think it takes a little bit of time for spending to pick up. And so I'd really be looking for better growth to be coming through. It may be late this year, it may be into early 2026. So a gradual turnaround coming through in the market rather than a rapid pickup.
And as normal, taking longer than we sort of first hoped for. But again, that confidence being such an important one, and when people aren't feeling confident, they're not, able or willing to go out and spend as much. They're being so much more cautious. We'll continue to assess how all of this goes, how retail sales themselves trend, how confidence measures adjust, and everything else in the economy on one of our future editions of Econ Talks.